When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Hogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events, what's happening in the market and the economy. We'll also answer listener questions, and then finally, achieving financial independence in retirement in honor of Independence Day. My name's Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom is solid advice. They come from the other Jeff in this radio program. That will be Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, happy 4th of July weekend. How you doing today?
Doing great. Nice to have a little bit of time just to kick back and reflect on how wonderful our country is and those people that have sacrificed and given us this awesome land.
Yeah, well, this is a great place to be during 4th of July. So many little celebrations going on in all the little cities and towns. So we hope everybody has a great weekend, a safe weekend. They come out of it with all their fingers and their thumbs. Happy birthday, America. 249 years old. She looks pretty good. Could use a little nip and tuck here and there if you've gone to some parts of the country. But all in all, doesn't look a day over 248. I'll just say that.
Right.
So a lot of stuff going on here. Let's begin our conversation this week, Jeff, and talk about current events, how it may apply to our listeners listening to us today. Let's first of all talk a little bit about the Fed. The preferred inflation gauge rose to 2.7% in May. That's a little hotter than anticipated. The inflation rate was around 2.3%. And along with that, Trump is sending a note to Jerome Powell. He's calling him Mr. Too Late. The note that was read from his press secretary, Carolyn Levitt, said, "You should lower the rate by a lot. Hundreds of billions of dollars are being lost, and there is no inflation. As usual, Jerome, you are too late. You have cost the USA a fortune." So we're expecting maybe rate decreases in July, but I don't think that's going to happen. I think we're at least until September. We may not see any the rest of the year. What is going on with the Fed at this point, and why have we not lowered interest rates so far?
Well, I've mentioned before, when we lower interest rates, it usually means that the economy is stinking it up and it needs to in order to get things going. But there's still a lot of stimulus money out there that still seems to be circulating, although the mainstream public person doesn't have it. Mostly it's just the traders and the wealthy. The things that support the economy are still kind of in play, and that's why we have inflation. The other thing is you can gauge inflation based on bond prices and interest rates and things like that. Fed really only controls the short-term interest rate. So if they're going to lower the short-term interest rate, that may help companies borrow short-term money to have working capital and things like that. But the economy, from the standpoint of production, sales, and other things, and even earnings, if you look at the forecasts, are going down, not up. And so, it does definitely point to recession. It has for a while. It just seems to be all the signs are coming together a little slower than they have in the past. Doesn't mean they're not going to end up in a place where we get to a place where they have to lower interest rates, but I guess we're not there yet. And if we see inflation going up, that's an indication that people are spending more on things or are willing to. I think the inflation is impacting what people can buy. If you look at housing, my gosh, there's the same houses for sale for the last 6 months in my neighborhood and nothing's moved. And
Right.
It just doesn't seem like there's a lot of action. And unless you're a rich cash buyer and you're buying your dream house someplace, maybe you can move and shake and bob and weave and go through the real estate market just fine. But the typical person, the Main Street person, doesn't seem to be thriving as well as they were. I was encouraged by the 2.3 inflation rate. And it seems like, all the hoopla about tariffs, the dollar actually falling in value, probably in reaction to the tariffs and other countries trying to manipulate currency and do things that they can kind of play that trade war game back on us. That's been working okay for them. The dollar has fallen in value. And typically when the dollar falls in value, we have things like gold, and gold seems to be a little stronger because the dollar's not as exciting. Typically we have people not really that interested in buying our bonds, so they have to offer higher interest rates in order to do that. And that's what's been happening up until just a few weeks ago. Bonds have actually fallen in price, making interest rates go up. But for the last few weeks, almost a month now, we've seen like the 10 and 20-year bond market has strengthened from the standpoint of prices going up, which actually makes interest rates go down. So effectively interest rates are dropping, whether or not Fed decides to make a formal announcement of an interest rate drop, which really isn't anything that matters much other than kind of gives us an indication of where inflation is at, this week or this month. And I don't think he's going to lower interest rates. He really has no reason to. The bond market's taken care of that in and of itself for whatever reason, even though the dollar's weak. Maybe foreign countries are saying, well, hey, our dollar goes a little farther. We can buy bonds at a discount and they're willing to take the interest rates that we have. But they have been going up since the election, and now they're starting to go down. Interest rates are going down. That'll help people that are looking at long-term purchases like mortgages and homes and things that they want to finance over long periods of time, because the longer-term interest rates are being affected by the bond market strengthening. And again, I don't think it's the dollar strengthening the bond market. Technically, interest rates are going down. That's not always a good thing for banks either. Banks kind of like higher interest rates because that's where the profits are derived. But at the same time, I don't think banks have been thriving a whole lot in the last couple of years anyway, because they're scared to loan money. Economic underpinnings are not really strong like they should be, even though we see the market going crazy. And like I mentioned before, earnings continue to be revised lower, consistently lower. Like every month, it looks like the outlook is lower earnings, which makes the price earnings ratios go higher and higher, which really should adjust the stock market down, which we saw at the beginning of the year. March-ish through April, we had a nice sell-off, which looked like a normal correction. And the tariffs got put on hold and promises were made by the market, and it got cheerled out of the slump. And it's been buying ever since. And I have no idea where all the money's coming from. I don't think it's coming from Europe and foreign countries because they're not really that thrilled about the dollar. Maybe they're buying bonds, but I don't think they're buying our stocks. If you look at Europe, their stock markets are flying high. Greece especially, I think, see Germany, Italy, Spain, Austria. I mean, all those countries that have been kind of flat for years are starting to look really strong compared to our market from the standpoint of earnings and growth on individual stocks. Nevertheless, our indexes are back to all-time highs. They got back there earlier this last week, and then there was some selling off and then some buying, and it doesn't really look like the market knows what to do, whether to bust through and stay high or whether it's to correct and start heading downward again. We'll have to see what the next few days. The last few days haven't given us really any permanent ideas because it's been kind of hot and cold. I remember when it first, last Tuesday when the market opened, the NASDAQ and the S&P stunk it up and the Dow went roaring ahead. So there's really some disconnect in the market right now. I think it needs to decide on whether it wants to continue to make new highs in hopes that the Trump economy will somehow rescue earnings and they'll start going up and we won't have a recession that we're due for. But then again, there's a lot of banks, a lot of Wall Street companies, a lot of hedge fund managers that are lowering their expectations throughout the remainder of the year on what the returns on the S&P or the market overall is going to end up doing. And most of them seem to be kind of flat from here, probably more of a bias down to flat than it is up, even though some people still think there's 8 to 10 points in profit between now and the end of the year. I have a hard time seeing that. I think it's going to be more choppy. But again, I'm just an opinion maker. We can all look back and find out what history actually did. And if we had a crystal ball, none of us would really have to work for a living. We'd just sit there and buy the stock market, but we don't. We just have to make educated guesses based on history, based on earnings, based on logic, based on what makes sense. What used to make sense was fundamentals. Now it's kind of, who's buying the stock and where's the money going? We see companies like NVIDIA lately making its all-time new highs. And we've also seen their insiders, including their CEO, apply to sell another tranche of stock. We're looking at billions of dollars worth of insider stock from NVIDIA insiders. That means their C-level and board members and people that are in the know are selling, not buying. And that's usually a sign that things are topping out and getting weak. We've been seeing that with Meta and Amazon and other companies that have been selling some of their stock ongoing for the last couple of years, even though the market still seems to want to push it higher. So again, there's not a lot of necessarily rhyme or reason other than the fact that it is. If you want to get on a roller coaster ride and not know where the turns are going and have some fun, man. It's not for the faint of heart, but the market could be a fun way to play if you like adrenaline rushes, or if you like the highs and lows that come and go with the highs and lows of the market.
Talking with Jeff Logan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, talking about current events and the market. We'll talk a little bit more about that in just a moment. Meantime, if you want to get in on the conversation, talk to Jeff about your individual situation, about the market, the economy, and how it would affect your journey towards a confident retirement, you can get your retirement roadmap absolutely no cost, no obligation. The number to call to get that, 520-780-9059, 520-780-9059. Make that call this weekend. Leave your name, telephone number, number. Shelley will give you a call back, set you up with an appointment to sit down with Jeff at no cost, no obligation. It is just a casual conversation for you to ask your questions to get the answers that you need to put you on a path towards a confident retirement. Again, it's not going to cost you a dime. 520-780-9059. You can also find out more about us online at premret.com. That is premret.com. Speaking of the stock market, Jeff, stocks have not been this expensive since 2003, 22 years. But the earnings just don't justify that. What is going on with the stock market, and what do you think we can expect here for the rest of the year?
Yeah, I don't know. I just touched on that, my last comment a little bit. It doesn't make a lot of sense. Earnings continue to be revised downward, yet the stock market continues to go up. The other thing that is interesting, the stock market continues to go up, and I just can't see that it's not manipulation, because typically there's really strong volume, and the volume's been just average at best the last few weeks, yet the market's still pushing through new all-time highs. The Dow still lagging a little bit, but it's headed there too, and the other indexes are knocking at the door, and we'll see if those all-time highs become support and are kind of the new basis for future growth. But it's not supported by fundamentals, and that bothers me. I mean, I've been in this game a long time, and it's just, it used to be, for the first 10 to 20 years of it, you could look at fundamentals, and the absence of fundamentals, usually meant there was going to be a crash. The last time there was an absence of fundamentals like there is now was the dot-com bubble, where as long as the stock had the word .com in it, it went to the moon, and it didn't even have to have earnings. It didn't even have to have a product. It just had to have a name, and people were just manufacturing money, kind of like Bitcoin. You come up with a password and it becomes money. Well, back then you just get a new ticker that said .com in it and it becomes money. A lot of the insiders and the Wall Street movers and shakers got rich at the expense of the Main Street working class that bought the hype, jumped in there, and then they lost all their money. And in Wall Street, they didn't get poor, but the market crashed and everybody else did. So we're kind of looking at the same type of situation where the market goes up regardless of fundamentals. And, we might come back to a time where fundamentals make a little bit more sense. They got a little bit more in play between the 2000 crash and the 2008 crash. And then the 2008 crash was so based on hype with all these collateralized mortgage obligations, CMOs, and all these bundles of mortgages where insurance companies would rate their basket of mortgages and give them the A+ rating and then sell them off. Is like, talk about a conflict of interest, as they're self-dealing in the biggest way possible. And they were buying and selling and using derivatives, leveraging them with options and things like that. And of course, that caused the 2008 crash. There was certain things that didn't make sense fundamentally there either. So we can usually get a glimpse of what may come as far as a correction, crash, or recession, whatever you want to call it, reset period, based on the fact that fundamentals don't matter anymore, and it's just this euphoria and stuff that drives the market. And honestly, we've seen it pretty much since the 2002. The 2002 crash was not really a crash. It was stopped by a bunch of stimulus. But in 2002, the market started going down. And I think to make it a good correction, or a correction instead of just a momentary blip that for 8 or 9 months people lost money and got freaked out, and then the market came back based on the money printing games and the insider bank dealing games with the Fed and banks, and just creating this fake economy. Really, it's this fake Wall Street valuations of bank stocks, money, interest rates were being manipulated, and the market just had nowhere to go up because they just kept throwing money at it. Money that they didn't even have was being thrown at the market, so it drove it up. So those are the kind of things that have happened. So for 2 years plus, we've seen the absence of fundamentals driving the market, even though they keep saying, oh yeah, but based on forward price earnings, the forward price earnings ratio is 25. That's way lower than the 38 that it is on the current. Well, the current keeps on going from 33 last year. This year it was supposed to be 25, but it didn't. It turned out to be 38. It's higher, not lower. Next year it's supposed to be 25 again. That means it's going in the right direction. No. Normal price earnings ratios, where we consider fair value over historical timeframes, I'm looking at the last 100 years, is somewhere in the 16 or 17 price earnings range. That means we're willing to pay $17. If a company earns $1 a share, we're willing to pay $17 a share for that. But right now we're paying $100 a share for that. That's ridiculous. If a company makes $3, maybe that's a $50 stock. Well, we're paying $100 or $150 for that stock right now. If a company's growing and doubling its revenues every year, yeah, I get that. We would overpay for that stock because in anticipation, we're just trying to get on the cutting edge of the run up, which, like NVIDIA is a good example of that. Tesla has been that way a few times. Apple was that way for quite a while. Microsoft, all the big Magnificent Seven companies have been out there where they can maintain 25, 30 price earnings ratios because they're growing at 20 and 30% per year. That makes sense. But the average rate of growth is like 6 or 7 with the good companies on average. And you're looking at growth being almost zero if you look at the entire population of stock market. If you look at the S&P 500, It's been like 1 or 2% for the last couple of years. And I don't know that we're going to see positive earnings this year with so many things kind of in place. So again, I'm not trying to be the doom and gloom guy. I mean, we've been making money on our growth portfolios because money's been going into it. And if you have money to risk and you're willing to ride the market out and take your chances, it might be a place for some of your money. But I still have to be the voice of caution when I deal with mostly retiree money, people who are retired or getting ready to retire that can't stand to take a big correction. We remember the 2000 crash took 6 or 7 years before the market got back to where it was before it crashed. 2008 crash, same thing. It was 10 years of zero earnings. If you look at the price at the year 2000 compared to when it finally got back to even a state above, that was actually 14 years till 2014. So if we go into another period like that, you're not going to want the money you need for income to be in the market. And that it's kind of unfortunate because we can't take advantage of the, what I call this stupidity in the market right now that it's going up. If we had a crystal ball, we just throw it all in there and go, oh, well, we'll just throw it in there for a couple of years. And then when the market returns to some sort of a fundamental look, or there's a nice sell-off or a recession, when the feds run out of money they can print, finally takes the market down, we'll already have made our profits and taken it off the market and taken our profits. Well, I wish we could time that. We can't. We just have to be smart about it and make sure that we're not in too high a risk when we can't afford too high a risk. I still think the market's risky. I still think based on the numbers coming in, our GDP isn't growing at 6 or 7%. It's growing around the 2 range. And shoot, that can be attributed to nothing more than population growth. It's not really a healthy level to generate 10 and 20% earnings growth with companies that are based here or that are listed on our stock exchange. If inflation can be kept at bay, if the manufacturing that Trump promises to be returned here based on the tariff negotiations and things like that, if that all comes to fruition, I think in a couple of years, the market's going to look very healthy. And I think it's going to look awesome. I just don't think it looks healthy enough now to be throwing money at it when it's at an all-time high. Yes, it's going to always make all-time highs eventually, but consider this. The last all-time high was like 7 months ago. It was pretty much flat for 7 months. If you had a bond, you would have made more money between December and now. If you had a CD, you would have made more money between December and now than if you had just a market index. If you've been picky about the stocks you buy, maybe you did a little bit better. Or if you've had a stock and a bond portfolio, you probably did worse on bonds, a little better on stocks, and you're probably still negative to break even at best. So we're kind of in a transition period where we're going to decide. I think the market's going to let us know if it's run out of gas or not, probably within this next quarter. You know, we just started a new quarter in first of the week, and we're looking at what happens now. I think a lot of the run up in June was window dressing so that companies could end with quarterly profits. And a lot of those profits are derived from a lot of their trading and stock sales and things like that too. So, or the stock price. Look at how much the stock market went up. Man, the economy's doing great. Q2 was awesome and people thought we were going to have a recession. Well, they might have just kicked the can down to recession in Q3, which we're in right now. And the snapback might be even harder because we artificially blew the balloon up with really no earnings, yet everybody wanted to see that all-time high, and enough of the hedge fund managers, bankers, and other people that had money laying around decided to put it in the market and pump it up. And even though the volume wasn't high, we hit those highs, and we'll see what happens going forward.
Talking with Jeff Logan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about current events. Jeff, you talked about tariffs a little bit. The Tariff Liberation Day pause expires on July 9th. That's just about 4 days from right now. Failure to strike some new deals with the EU and Japan, China, and so forth, that could double tariffs and shake up markets. What do you think is going to happen here if we do not strike deals? How's the market going to react to that?
I don't know. I think sometimes the deals, if the market doesn't like the deal, it's going to react negatively. If the market likes the deal, or just, I think if the deal just gets done, there's the idea that the market could say, oh, good, well, at least we got the deal now. Let's move forward. I don't think anybody's really looked at what the deals mean. I think everybody's just speculating. And if they want to be in a bull market, they're saying, oh, the tariff deal's a good thing. If they want to be in a bear market, they say, oh, the tariff deal's a bad thing, and they'll sell. So I don't know if there's consensus on it because you hear both sides. And I don't really have an opinion on it. I think the tariffs put us on a equal playing field. And if the tariff negotiations can mean we make a little bit more on our exports and we make a little bit more of our products here in the U.S. and employ more people, I think America's going to be a better place and those companies are going to thrive. And I think the stock market will have fundamentals that make it thrive rather than just the hope of someday fundamentals might get better and we can just leave the market overvalued and just continue to prop it up without really any fundamental reason for it. So, I don't know if the trade deals, I know that, man, at the first of the year, they'd make the market swing huge one way or the other, just depending on whatever the news said. The tariff deal meant. And I think just to get them all behind us, if we could just iron these things out, would sure be nice. I think if it doesn't happen, I think the market is just going to kind of be choppy and kind of meander its way along, maybe where it is, maybe sell off a little bit while it waits. But I think once the trade deal is done, I mean, if it looks good, if it looks like manufacturers and companies at least have a picture, or at least they know the rules, I think they can make better plans, and that might be another healthy market, might prop up the market a little bit for another run. If, however, it looks very one-sided, or if companies say, well, screw you, we're not sending your products anymore, or, oh my gosh, that looks like it's going to cause way too much inflation, or if companies that have to import products and pay tariffs in order to make their own causes the manufacturing of their products and the sales prices to go up, that might impact their sales as well. So again, every company kind of knows how that deal is going to affect them, and every company has a different reason for liking tariffs or hating tariffs. So while some companies may like the deal, other companies may not. And I think it's going to be important to, if you are a stock picker, be careful on how you pick based on those deals, and be careful on what those deals mean to the fundamentals that may or may not drive the price of that stock or make it a wise investment or an unwise investment. If, however, you're just chasing the money and you just want to say, well, the market overall, there's more good than bad, so the index is going up, well, then I wouldn't try to dissect the market and pick individual stocks. Just ride the index, which is what most people, do nowadays, which actually increases the buying that you have to do in order to manage an index ETF or portfolio, actually creates more buying and more volume on certain stocks that prop the market. It's kind of a self-fulfilling prophecy. When you start buying the index, they have to buy those stocks that make the index go up more. So that's probably why we've had a little bit of a false look at valuations in the market, is because so many people are just playing the market, not buying the individual stocks. They're not buying and holding in where they're trading. So many people are just playing the indexes, and the indexes are weighted. They're cap weighted. I've talked about this before, but rather than getting a long discussion about it, it just means some stocks get more money thrown at it just because they're a bigger company than other stocks do. So you don't get a real accurate look of what each company is doing when you buy the index. You just get an accurate look of what 7 to 10 companies are doing based on excessive buying, because everybody knows the Amazons, the Netflix, Nvidias, the Teslas, Apples, and Microsoft, Googles, and Meta. Don't forget those. So again, those big stocks kind of drive the market. If you want to just own all of them and just own the consensus, then buy the index. But I think if you're trying to manage money, it's going to get increasingly hard as those tariff deals come through and we finally dissect what they mean.
Jeff, just one more question before we break here. The various pundits in the electronic media have mixed opinions about the market, from mild gains to recession. Where do you stand the rest of the year?
I've always kind of probably sounded like a pessimist. I think just based on the historical overvaluation of the market, we're already so high that I have a hard time believing that we can sustain this forever. We've sustained it probably 6 months to a year longer than I thought we could. We were paring back our exposure to the market 2.5 years ago. When the market crashed in 2022, we really never got both feet back in, just because it was still overvalued. And the correction that started in 2022 never really got, I don't think it ever played out. So we're kind of waiting for that to all play out. We're hoping earnings can grow to prop up the market where it is, but I still think there's more downside potential than upside. So I still think that there has to be a nice sell-off. I don't know if that's going to happen this year. Every time I think it's going to be next quarter, it's the next quarter. And we've been able to keep on kicking that can down the road. Wall Street games, Fed games, banking games, political games. Nobody wants to have it happen on their watch, chances for re-election and things like that. I just don't think the market can. It's like a balloon. It can only hold so much air, especially hot air, especially fake air. And I think the market's at that breaking point now where something may pop. Even if it doesn't pop, I think this high that we've just returned to may be a basis for some support going forward to a very small degree, but I don't think it will hold up very long. I think it'll be tested again and maybe tested again, and then it'll fail. So I think if it's not within the end of the year that the market ends up down 5 to 10%, maybe even 20% from where it is, I think that would be kind of a healthy area. If the correction becomes a big sell-off, I don't think that even a 50% sell-off from where the market is not necessarily an unhealthy thing. It would rock a lot of people's worlds and make a lot of people upset, but it would get the market back to where fundamentals would then make sense again, and you could pick and choose investments that made sense, build a portfolio for the next decade or so that made sense, that you could count on or at least predict a little bit better than what you've been able to predict the market nowadays. So again, people don't even make individual investments anymore. They just buy the index because there's no rhyme or reason to pick investments anymore. So we might get to a point, if it's bad enough, to where individual investments make sense again. But if not, I don't think 10 to 20% downside from here is unreasonable. And again, if dollar cost average in, if you're continuing to invest in your 401ks and things like that, don't worry about it. If you're trying to time the market, well, I hope you're watching it every day because it's pretty hard. I don't know when that'll happen, if it will happen, but if you're in it for the long haul, those things shouldn't bother you. If you're living off that money, then you shouldn't probably have that much exposure in the market anyway.
If you'd like to sit down with Jeff on a one-on-one basis, talk about the market and the economy, how it may affect you and your journey towards a confident retirement, we're offering the Premier Retirement Roadmap. Absolutely no cost, no obligation. All you've got to do to get it, call 520-780-9059. Make that call right now. Leave your name, telephone number. Shelley will call you back during the week and set up a time for you to sit down with Jeff on a one-on-one basis. Again, it's just a casual conversation at no cost and no obligation. 520-780-9059. You can find out more about us online at premret.com. Jeff, let's take a break. When we come back here on Premier Retirement, we've got listener questions and finally, how to achieve financial independence in retirement. When our program continues on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thanks so much for making us part of your 4th of July weekend. You're listening to Premier Retirement with Jeff Hogan. Hope you have a safe and happy 4th of July weekend. If you're listening to us in the radio, more than likely you're listening to us at one of our 4 times. Saturdays at 7 a.m., 9 a.m., and 1 p.m. We're also on Sundays at 11 a.m. If you've missed any of those broadcast times, we're also a podcast. You can go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. We've got all of our shows up there so you can stay on top of your journey towards a confident retirement. Our phone number, 520-780-9059. You're listening to the program today. You'd like to set up a casual conversation with Jeff one-on-one to talk about your retirement situation. Maybe you've got a plan from someplace else. You want to run it by Jeff, see if he can give you some good advice as a second opinion. Maybe you don't have a plan. You've got a 401k, an IRA. You've got a lot of money in there. You're trying to create an income plan. You want some safe money. You want to figure out how it all works so that you will not run out of money in retirement. Again, that's a fair question. All you got to do, 520-780-9059, and we'll get you set up with an appointment with Jeff. Okay, Jeff, let's dive into our listener questions this week. We've got Mike listening to us in Tucson. Mike says, I'm 59. My wife is 58. I've recently lost my job due to an economic downturn in my industry. My wife's still employed. We're empty nesters. I'm contemplating an early retirement because it's becoming ever so difficult to find work at my age. My current situation is I have a mortgage of $70,000 that'll be paid off in 5 years. Interest rate 3.60%. So $1,300 a month in a mortgage. 401k, current value $508,000. His wife's 401k, $175K. $90,000 in cash and savings for emergency funds. Current projected Social Security is around $3,100 a month for Mike at age 67. Keep in mind he's 59 now. Wife's Social Security is estimated to be about $2,000, so that's going to be about $5,100. I want to determine if I can guarantee a $2,000 a month after-tax income needed for basic monthly expenses from my portfolio, hopefully without sacrificing future income needs. So can we make this work if I'm unable to secure employment, or do I need to try to re-enter the workforce?
I'm not sure I understood that, whether or not you need the $2,000 a month in order to cover you while you're not working, or if your wife's salary will at least cover you, but you just won't be able to increase your savings. Let's try to answer it both ways. I mean, if you look at the situation of where you're in, $800,000 at your age, are you going to wait to 5 more years is what you're hoping, right? But that doesn't even get you to the age 67 amount. So if you're thinking you have $5,000 a month coming in Social Security at age 67, it's really going to be about $4,000 in 5 years. So there's $4,000 a month coming in. If your wife's making enough money to cover your bills, you're just not able to save. I mean, there are options now that you're 59. As soon as you're 59 and a half, let's just use a round number. Let's say your wife continues to put in her 401k and the 175 ends up, maybe she can't put in the 401k, but let's just say it grows at 5% or so. And, now it's worth 225 or 230. Let's say you put 500,000 in your 401k into an index annuity that has income guarantees in 5 years. And you were able to basically make that a guarantee of maybe $800,000 or $900,000 worth of income value at that age, probably about $40,000 a year in income potentially off of the investment you have, as long as you don't have to dip into them. So again, if you take Social Security early, if you're able to make ends meet, that's one thing. If, however, you need that $2,000 a year to come out of that 401k now, or $2,000 a month, which is $24,000 a year, which for 5 years, $125,000, that's going to get your 401k down to maybe 400. So maybe you could move 400,000, use some 401k distributions. That 400,000 would then generate probably $30,000 a year. So if you're getting $30,000 a year, $2,500 a month in retirement at age 67, plus, less than the $5,000 you're anticipating at age 67. So it's going to be actually more like 64-ish. I see you living more in the range of maybe $6,000 or $7,000 a month, your mortgage would be paid. So I'm not sure if the 5 years was just when you're going to pay off your house, or if that was when you're trying to retire, or if you're really trying to get to age 67. But I gave you a couple answers there. If you can get to 67, you can probably live on $8,000 or $9,000 a month, as long as you can make ends meet. Until then, if you need to spend some of your money nowadays or now, it's probably getting even more like the $6,000 or $7,000 a month range. But it's not out of the question if you have no debt and you're used to living on a reasonable budget. I think, there's a lot of people I know that are doing that. However, I think just any job is better than no job, just to keep you sane. It might not be the engineering job you had or the high ticket job that you were used to, and you might feel a little bit unappreciated or kind of bummed out that a $100,000 a year job goes to a $60,000 a year job, but that $60,000 a year job will pay all your bills so that you don't have to draw down any of that deferred stuff. Now, something you might want to add to this mix is to maybe even do a conversion to some either Roth conversion or LERP conversions, where while you're out of work or while you're underemployed or making less money, you may be in a low enough tax bracket to where it makes sense to do some conversions from that IRA or the 401k, take distributions, pay tax on them now at maybe a 12 or 22% tax bracket rate, and then never pay tax again, either on income for life that is guaranteed from a Roth IRA that will never end and it'll always be tax-free, or you can guarantee it from a LERP. I like the life insurance version of it. It's a little more flexible. You don't have to take just guaranteed monthly payments. You just dip into it whenever you want to, and it's like a tax-free bank. Once you pay taxes on some of that IRA money and put it in it, that might also generate you $20,000 or $30,000 a year in tax-free money, which may in effect be better than $30,000 or $40,000 a year in taxable money, depending on what tax rates do in the future, how stealthy you want to be with your income and how much you want to show on your tax return. So again, there's a couple of different ways to skin this cat. I don't have quite all the information that I like to know if the retirement age is actually when you pay off your house, or if you just don't plan to work at all. If you don't plan to work, do you have to use some of your income, or are you planning on trying to get to 67 no matter what? So again, a little clarity would help me, but I think I've given you enough food for thought, something to chew on, and hopefully helped you get on the right, at least point in the right direction. If you need more help, feel free to come in.
That's right, Mike. 520-780-9059 is our telephone number. If you'd like to talk to Jeff, sit down and hash this out. I think any job is probably better than no job, and giving up on getting a job, I think, is probably not the way to go. But I think if I'm seeing his question correctly, Jeff, he's going to have about $700,000. He wants to know if he can turn that into $2,000 a month after tax income. But again, just all depends. Come and talk to us. 520-780-9059. Mike, thanks for listening to us in Tucson. We will send you out Jeff's book, Retirement: The Road Ahead. Next question, Sam's in Vail. He says, I am 60, married, plan to retire in about 7 years. I have around $500,000 in equity and a 401k with a $400,000 balance. It's got like $900,000. Other than a few thousand in my checking and savings, I don't have any liquid cash assets. How much cash should I have on hand, and in what form?
Well, it kind of depends what you need that cash for and how quick you can access some of those other assets. Now, I do think that home equity is basically a bank account you can use, but you can't readily get to it if you can't get a HELOC or whatever. I think just having a certain amount of cash sitting around is smart, just to get you through fix the air conditioning or fix the roof or just go on a little trip or something. But everybody has a different threshold of pain on that. Some people are happy with $10,000 in their bank account and leaving everything else in their 401ks and other things just deferred for later. Now, keep in mind, a 401k only takes a few days to get money to your bank account. So it's not like you have to pull money out of the 401k to pad that savings account. You have 500,000 equities. I don't know if that is equities in an IRA or non-IRA. I'm assuming maybe if that's a non-qualified account, those equities can be liquidated at basically any time and put in your checking account. So maybe 10 or 20 grand extra just that you can get today to write a check on or to get cash on. And anything you think would be an expense that you could wait 3 or 4 days on to pay for. Even the worst bills typically aren't going to require hundreds of thousands of dollars or even tens of thousands of dollars up front. And if it is, it's one of those things you anticipate and have a few days to prepare for anyway. So I think you're plenty liquid. I don't think you need to pad your checking savings account, make no interest on money just because somebody says, oh, you're income $7,000 a month and you need 6 months of security cash income available. Well, you've got more than that just by liquidating your stocks, and you can do that in less than 6 months. Why take zero interest and do that just because some rule of thumb or some dude on the radio who talks to broke people thinks that's what you should do? So It doesn't matter to me. It's whatever you're comfortable with. In my opinion, 900,000 in total assets is plenty liquid. You're 60 years old and you can use it all at any time.
Okay, so what you're saying with the 401k, he could have that money to write a check against in 3 or 4 days?
He could if he wants to pay tax on it, but if he doesn't want to pay tax on it and just wants to deal with some maybe capital gains or sales, depending on what he has as investments, and he says he has equities, some of those might be pay-as-you-go equities or maybe dividend stocks where you're paying on the dividends as you go and you don't really have a low basis where if you sold $40,000 worth of stock, you wouldn't have a big tax bite. The thing with the 401k is you do have mandatory 20% withholdings. You also have to pay taxes on 100% of that money if you haven't already. So one of the things you could do to get a little bit more flexibility so you don't have that mandatory withholdings on the taxes, because sometimes you're pulling money out that's going to be an offsetting tax deduction, yet a 401k makes you withhold 20% minimum in taxes. Roll it to an IRA. Once you're 59 and a half, almost every plan I've met that's in a 401k, unless it's a super small company and it's a personally directed 401k with kind of a different than boilerplate plan that most of them run by, you can change a 401k into an IRA, self-direct it, have similar investments, maybe even more things available to you, create quicker liquidity, and you can get the money out of there a lot quicker without having to pay taxes on it. Now, one thing that is good about a 401k, your plan probably allows you to take loans, hardship loans, or just loans for whatever reason you want to call it, up to a certain percentage of your 401k. And that would be a non-taxable event because it's actually just a loan. Now, keep in mind, when you either decide to call that loan, okay, I'm just going to keep the loan, I'm not going to pay the loan back, then it becomes a taxable event as soon as you decide that. So keep in mind, you will pay taxes on it in the future. But if you're 60 and you haven't retired, you got 7 more years to retire, it might be smarter just to loan or take a loan from that 401k, especially if your 500,000 in equities is all Apple stock that you bought at $20 a share, you're going to have a big capital gain selling some of that. Now, if you have all of it in one stock, you should have already sold and diversified. But my point is, you might be sitting at a place where you really don't want to show any additional earned income or even capital gains income because you're right at the threshold of a new tax bracket or something, or right at the threshold of some means tested benefit that you might be getting somewhere. And this might not speak into your specific situation, but people who are deciding whether or not to sell a stock as opposed to take a loan from a 401k may need to take these other things into consideration. And honestly, most people don't even know what questions to ask or what things to think about. We do it every day. So it might be smart to contact an advisor that does comprehensive planning that includes the math included, that looks at your tax brackets, looks at the damage you do by pulling money out of each account rather than just, hey, what's the net I can get and will it pay a bill? Yeehaw, I did it and off to the next thing. Pulling money out of IRAs and RMDs and borrowing from 401ks, all those things have tax ramifications. And if you're doing it without a plan, you just kind of find out what you did later. And you find out what harm you may have caused yourself later after the fact. You don't usually know about it in advance. So my point, and we've always been, from retirement planning, let's plan for the retirement. Let's plan your distributions. Let's plan where you're going to get the emergency money out of. Let's plan where you're going to pay for your income for retirement. Let's plan on how much of it you want to be taxable. And let's plan on how much you want to leave in some stealth account like a Roth or Alert that nobody really looks at from a tax standpoint. And you can pull money out anytime you need an extra chunk of cash for something and not go into a new tax bracket. So there's several things that you ought to think about looking forward rather than just say, oh, well, I'll do what I need now and we'll see what the tax man says next year when I do my taxes. And, oh, well, we'll just pay up in April and hope I don't get penalized too bad.
And I've heard on a regular basis this adage that says that you should have 3 to 6 months of expenses in liquid cash. But you're right. If you've got it in a savings account, money market, something like that at the bank, it's going to pay less than 1%. If you've got it in a CD that's paying 4.5%, 5%, if you're lucky, you're going to have a penalty for early withdrawal. So I'm with you. Thanks a lot there for the question, Sam in Vail. We appreciate you listening to us. You'll get Jeff's book, Retirement, The Road Ahead. Okay, next question, Jeff, is Jim listening to us in Rancho Vistosa. Jim says, I'm single, I'm 81 years old, and I need a financial estate planner as well as an attorney for a will. All of my investments are in mutual funds that I've managed myself through the years, mainly because I've had a bad and costly experience with both financial advisors and lawyers. I therefore keep my financial situation to myself until I've established a trusting relationship with someone. I'm skeptical of advice from almost anyone, professional or not. I know I can't keep putting this off much longer. Do you have any recommendations for me?
Well, I don't know. You're calling the show, so I'm guessing you already know what I'm going to say. I think getting to know the person that you deal with is smart. I'm very old school. I like looking eye to eye and having people come in and sitting with me at the conference table and talking about their plans. I think, well, you build that trust, and I've always held to that. So many people nowadays are just doing everything online and just throwing out half-baked recommendations with half-baked promises and forgetting to tell you the upside, downside, and the backwards and the sideways things that could happen to an investment. I think it's better to get educated and be more comprehensive in your approach. The thing about being 81 and doing it yourself is you've always had just mutual funds. Well, you've been using one tool in the bag and it's got you as far as you've gotten, and you haven't been too bad, or you would have been looking for an advisor some help before. I don't blame you for knowing that there's advisors that might be congruent with yours, or maybe getting their agenda from somebody up level management. For example, I worked for a Wall Street firm and I was told what to sell every day. It didn't matter if the fundamentals were good or if the client needed it or not. I just had to do the quota to keep my job. And, I felt like I was a puppet on their strings, and I'm sure people blame me for being a bad advisor, even though, it was somebody that I didn't even know and somebody that didn't even know my client that was making the recommendations or making the buys and sells accordingly. I think if you had a situation like that, you were probably underserved. I was too. I dealt with that deal for a little less than 3 years. I couldn't get a grip of how that was good for my clients or good for me or good for my psyche. I was getting ulcers and headaches every day. And I thought, man, I'm 23 years old. I can't be doing this. I guess I quit when I was about 24 or 25, but I was too young to be going through that kind of stress. And if you can find somebody who takes the word fiduciary seriously, that will look at your situation and do the best that he can for you based on his knowledge and experience. Now, you might say, well, shoot, I could have done better there. He's a bad fiduciary. Well, a fiduciary does, based on their experience, what they feel is best for you and best for your goals. You may want to interview several fiduciaries. And what I say about fiduciaries is typically a fiduciary is not supposed to take orders from management or somebody else, especially those people who don't know you. There are companies that even advertise on TV that considers themselves fiduciaries. They call themselves fiduciaries. They say they do better when you do better, but forget to tell you they do better when you do worse. And don't mention the fact that they have the same portfolio virtually for everybody. And it's just one thing. It's just a long-term portfolio, which sounds like maybe that's what you've done. And in that case, you've saved yourself a lot of frustration, and you've probably done a lot better because you've managed yourself and not had to pay a fee for a similar situation that you could have got into with somebody else that would have just plunked your money in mutual funds, let it ride and see what happens over the long haul. And you're 81, so you've probably been in it for a long haul. You've probably done well. And, if you haven't needed that money for income, great. If you're 81, you probably got pensions, you probably got Social Security and other things. And you're also probably old school enough to be out of debt, so you didn't really have an expensive retirement. And you could let those aggressive investments ride. Maybe you still can. Maybe you just sell the mutual funds, and, if they're in 401ks and stuff, maybe you're a little older than where a lot of that is in a 401k or some sort of a qualified plan. I mean, most of those mutual funds have probably been peeling off 1099s for all the trading that they do inside the mutual funds. So there's probably not a taxable basis that you have to worry about. So if you wanted to just sell them and make it easy, and you just want to keep riding the market, plunk it in the market, just buy a S&P 500 fund. If you want an advisor because you're worried about maybe just losing the ability to watch your own money, then I think it's time, as long as you still have your faculties and you're 100% mentally focused and can do it, is find an advisor that aligns with you. You might have to interview and kick tires with a few of them, but interview them and visit more than one or two times. Most of our clients come aboard after the third or fourth visit, not after the first or second. First of all, I want to see if I even like the person the first visit. As an advisor, I might work both ways. You want to see if you like the person. If you like the person enough, if both of you like each other enough for a second visit, have a second visit and talk turkey, talk more about the details, and then go home with some of those details, mull them over, bring back questions, and do that a time or two until you feel comfortable that you're on the right page, that this person's looking out for your interest. But yeah, life's too short to deal with somebody that you feel uncomfortable with, or somebody you think is ripping you off or isn't giving you some sort of value. And honestly, I don't know that you can really judge value based on the fact that a financial advisor, let's say the financial advisor, you're up 12% last year on all your investments, but the market made 23. Is he a bad advisor because he didn't beat the market? Well, maybe your goals was to not risk all of your money. So maybe your goal was, hey, I just want to make sure I can retire and I want to average at least 6. Well, in that case, that fiduciary did a heck of a good job for you. They didn't lose your money. You made some money and you took very little risk compared to somebody that was all in making 20+% in the market. Does that person give you tax advice? Do they tell you when to roll money to a Roth, what account to take your money out of? I had a guy come in, before he came in, he did what he thought was such a smart thing. He converted his entire asset base, over $1 million, to a Roth IRA from a 401k. And he came in and said, yeah, I already did the 401k transfer to my Roth and to an IRA. I said, well, do you know that's going to cost you $400,000? He goes, it is? Yeah. He goes, oh, why? I said, because you just got into the highest tax bracket possible. I would have probably moved half of it over the next 5 to 10 years, and you'd have never been in a higher tax bracket than the 22 where you are right now. So again, Would that guy have saved some money by coming on board and paying me a 1% fee to manage his $1 million? Would that be better than paying $400,000 in taxes? Shoot, that pays for a lifetime of fees. And just one decision could be made to justify a fee. So some people are fee weenies and just don't want to pay a fee, and that's why they don't want an advisor. But we got to keep the lights on around here. We do a lot of services. We add tax planning. We add our expertise and years of understanding different markets, different products, and different strategies that may be available to you, and you have no idea about it. Here's one. What about using your required minimum distributions and giving them direct to your charity instead of taking them as income and then contributing to your charity? That way, it never even shows up on your tax return. It never shows up on a 1099. And it never shows up as a taxable event. You just end up burying inside of a standard deduction anyway. So if you gave $10,000 a year to your church or a charity, and you're taking it out of your IRAs, it comes in as on your tax return as a taxable event, and then you write it off against your taxes. But you have a $14,000 or $15,000 standard deduction. If you're married, you have a $30,000 standard deduction. You never really get to use that $10,000 gift to the charity because you just lost a deduction of about $2,000. Well, shoot, that goes a long ways to pay for an advisory fee, right? So again, if you can find an advisor where you understand why they're getting paid and what value they're adding, then it might be a little bit more palatable for you to use an advisor. The other thing is I wouldn't be using mutual funds. I'd be using similar ETFs. That'll save you about 1% a year just in management fees on the mutual funds, not to mention the losses that they get from buying and selling and basically churning the account, which mutual funds are notorious for doing. And you don't even see the profits they're making inside the fund that you could be making just by buying, holding through ETFs and paying a fee. You might have been 1 or 2% better off if you looked at your long-term actual growth rate. So again, look at the whole picture, find out all the information. You might find out that there are advisors out there that take their job seriously, that take the word fiduciary seriously and actually look after their clients. We believe we are the premier firm in that category, and that's why we call ourselves premier, and could help you. There's others. I'm not the only one, but I think you should kick tires and find out who you feel comfortable around, who you like. Life's too short to deal with somebody you don't like, especially when it has to do with your money.
Jim, we appreciate you listening to us in Rancho Vistoso. Again, if you'd like to come and sit down with Jeff, get the conversation started, trade some questions, 520-780-9059 is our telephone number, 520-780-9059. Jim, you can make that call this weekend, leave your name and number. Shelley will set up an appointment for you to talk with Jeff. You can come into the office, we can talk to you by phone, whatever is more convenient for you. But again, we've got to begin that conversation to see whether or not we're a good fit for you. 520-780-9059. Jim, we're also online at premret.com, PREMRET.com. Well, Jeff, it is Independence Day weekend, and in honor of Independence Day weekend, I wanted to talk about financial independence. Everyone wants financial independence. In the few minutes that we have left here in the program, Jeff, what sage piece of advice would you give someone who says, Jeff, I want financial independence. Where do I start?
Well, financial independence, that connotes a lot of things. So first of all, I think you can call yourself retired when you're working because you want to, not because you have to. And what that means is that you know that no matter what happens, the income that you are receiving is more than going to meet your obligations, more than meet your monthly bills. And then there's a lot of fudge factor in the rest of the money that you have. We have the 5 pillars of planning. Let's make sure that you have an investment plan where you're not taking more risk than you should. We'll make sure that those investments create income, that we can generate guaranteed income for life, not just for a few years, for a fixed period of time. I want to make sure that we're saving taxes. I think financial independence has a lot to do with kicking the government out of your life, getting their hand out of your pocket, keeping your money, being independent, meaning being control of as much of that nest egg as you can. If you can convert your retirement income into tax-free income streams instead of taxable income streams, if you can sock away all your savings money in an account that grows tax-free, that doesn't have any risk to its principal, grows tax-free at better than CD rates, then you can grab that money anytime and never have a 1099 generated. And when you die, all those accounts, the balance of those accounts, sometimes even more than the balance of those accounts as a death benefit, may go to your heirs and leave them a non-taxable event. That's the biggest thing, I think, from financial independence is getting the tax man. Independence Day connotes the idea that America is a great country, and it's a great country because it lives off of a lot of our hard work and the taxes that we pay, but we shouldn't overpay taxes. There's a law and a code and rules to go by. If you take advantage of those rules and you keep your money in your own community, guess what? You're spending that money and you're buying goods and services from a lot of other families who are paying taxes. I don't think that just because you're not paying taxes, you're not creating good for the government or good for America. You are actually creating good for not just your family and your own community, but good for the overall economy and financial independence, not just for you, but for a lot of families So I think if you can control your taxes, that's a big one. Then, of course, financial independence is knowing you're not going to lose your nest egg if you have to go to a nursing home, and also knowing that you're not going to lose it in probate or from estate taxes when you die, that you've done some protection planning there. So those are basically quickly the 5 pillars of planning, and we believe that those are the pillars of support for a worry-free, financially independent, let's say, peace of mind and confidence in retirement. That's really where it all is at.
If you'd like to begin that journey towards financial independence, the first step would be to give us a call here at Premier Retirement. 520-780-9059 is our telephone number. Again, make that call this weekend. Shelley will give you a call back, set up a convenient time for you to begin that conversation. And it's just a casual conversation, and there is no cost, no obligation. 520-780-9059, also online at primrat.com. Jeff, out of time for this week. Thank you so much for your time. Most importantly, though, as every week, I want to thank our great listeners here in the greater Tucson area for joining us. So for Jeff Hogan, I'm Jeff Shade. Have a great weekend. Talk to you again next week right here with another edition of Premier Retirement on 790 KNSP, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.